Dear friends, we shall now do chapter 5, which is entitled Basic Life Insurance Products. This is an important chapter because you are prospective life insurance agents or advisors and you are going to sell the products. So you should have a correct understanding of the products in order to be successful in the sale of the products. You can expect 2 questions from this chapter in the examination. We shall first see what are the learning objectives. Outline the various protection needs of an individual. What are the needs of the individual for insurance? When you want to sell a product to a person, you must be sure that he needs it. Personal factors affecting protection needs. Basic elements of a life insurance plan. Basic life insurance products offered by the insurance industry. Different types of life insurance plans. Tax implications of life insurance products. How inflation has an impact on life insurance products. Prioritize client needs and apply basic life insurance products to meet those needs. These are the points we are going to cover during the course of the lesson. What are the general protection needs of an individual? The needs of an individual may be a protection need, that is a need for protection, or a need to save. We are first examining what are the protection needs. First is income, then is medical needs, 3 dependents, 4 assets and liabilities, 5 retirement income. These are the 5 protection needs of an individual in general. What is income? An income is brought by the individual to the family and he supports the family with his income. When he dies, the income is no longer there. So we have to protect that income. We should see that the income keeps coming to the family even after he is dead and gone. How can we do it? How does an income come generally? There are 2 ways of getting an income. Number 1, man at work. A person is working and an income is coming. Number 2, money at work. If you invest money also, it will yield interest or dividends or rents. So, if you want income, either a man should be at work or money should be at work. So, at present, the individual is taking care of his family. We should take care that even if he dies prematurely, the income will not stop. The family should not be in the street. We should make some alternative arrangement for the family. Then medical needs. Medical needs are most important. Now modern medicine is working wonders. Treatment has become more and more costly, almost prohibitive. But we cannot afford to do without treatment. When you have a problem, we have to go for treatment. So how to take care of this problem? Health insurance policies are there. By taking health insurance policies for the entire family, you can be sure that whenever there is a complaint, a medical complaint in the family for the individual or any member of his family, we can arrange for the best possible treatment for those people. Because we take the treatment from a good hospital, be it a corporate hospital or a government hospital, and the bills will be reimbursed by the health insurance company. So that arrangement can be made. Then dependents. Before marriage, the individual was a loner. Now he is having a wife, 2 children. After some time, his parents also may join him. So he has to take care of not only of himself, but also of the dependents. It's not simply feeding and clothing them. You have to take care of the education of the children and also the marriages of the children. So the dependents' needs are to be taken care of. Then assets and liabilities. Now people, everybody wants a car, everybody wants his own house and all this. There's nothing wrong, but you have to go in for a loan. Few people have the ready cash to buy a house or a car. So you take a loan from a bank and you acquire a house or you acquire a car. Now supposing the individual dies, how are the loans to be cleared? The income has stopped and the person is no more. The creditors will be after the bereaved family and they have no means of clearing it. Then what will happen? The bank will come and seize the car and the bank will seize the house. The family will be evicted from the house. That should not happen. We have to make some arrangements to see that such adverse circumstances should not arise. Then retirement income. Everybody has to retire sooner or later. Very few people are in pensionable jobs. Most people are in jobs where there is no pension. There may be some provident fund and some gratuity, but all that is spent in no time. We require a steady income. For that, there are policies like the annuities. So you have to make arrangements for the retirement income also, not only for you, but also such members of your family who have not gone out by marriage or by getting a job elsewhere. What are the personal factors affecting protection needs? I mean, how do the protection needs vary with some factors? Number one is age. A young man of 22, just out of the college, he has got a good job. His requirements are very few. He has to take care of himself. He is a bachelor and he has to take care of himself only. After he is married, he has to take care of himself and his wife. Soon children will join them one by one. He has also to take care of them. And lastly, the parents also may come and join him after their retirement. So, dependents also you have to take care of. So, if a young man of 22 wants a policy, he will not think about the children's marriages because he is still a bachelor. He will think about some family protection or some risk cover for his own life. He will go in for a term assurance policy. What a term assurance policy is, we shall presently examine. Then dependents, as we have seen just now, as dependents increase, you have to make more and more arrangements for them. As I said just now, when children are there, right from the date of their birth, you have to arrange for their education because education can be costly and marriages can be very costly. Then income. The policies a person will take will depend on his income. If there is a person with a very low income, you can't go to him and ask him to take all policies for all types of needs. He is barely able to maintain his family. So, the income of a person, it plays a very important role regarding his needs and how well he can take care of those needs. Lastly, assets and liabilities. We have seen just now, if he has acquired a house on loan or if he has acquired a car on loan, he has to make some provision. Should he die, the loan should be automatically cleared. Otherwise, number one, the bank people will come and take away the assets, number one. Or the creditors will be after the family and all that. To avoid all these things, we should take term assurance policies for the amount of not only the assets loans, but also you may be having a personal loan or you may be having some credit cards and some balances are there. Taking care of all these things is very important because a family cannot afford to bear the burden without you. Even when you are there, you have a lot of difficulty in meeting all the requirements. So, some pakka arrangement should be made to see that when the person dies, the family will have a smooth life without these problems and difficult situations. Now, life insurance plan. Life insurance. What exactly is life insurance? Life insurance takes care of some events which are contingent on the duration of human life. Life insurance, for example, life insurance won't take care of any fire accidents. And what are the two dangers that can happen to a person or a person's life? Two things can happen to him. Number one, he may die prematurely, leaving the whole family as a bereaved family and a family without any support. Or he may live up to a ripe old age, but then the income is not there. After retirement, the income stops. And very few people are in pensionable jobs, and what few amounts you get by way of PF and gratuity, they get spent in no time. So, some arrangement should be there. Actually, in insurance books, they generally speak of these two perils of life insurance. Perils means events on the happening of which life insurance can come to your rescue. The twin perils of life insurance are said to be the danger of dying too early and the danger of living too long. These two are the dangers. These two are the twin perils of life insurance. In other words, the first thing, the danger of dying too early, we will call it family protection. And the danger of living too long, we will call it retirement income. So, family protection and retirement income are the two major factors which are being taken care of by life insurance companies. And so, any life insurance policy will be providing two things. I mean, one of the two things or both of them. One is the death cover. If a policy is there, how much do they pay on death is the main important question. So, death cover is the first point. And the second is maturity benefit. Are they going to pay something on maturity? If so, how much is it? So, when you examine a policy, you have to see what death benefit it is offering and what maturity benefit it is offering. These two things you have to see. Now, what are the various basic life insurance plans? First and foremost, term assurance policy. We have seen just now. Term insurance policy or term assurance policy. Term assurance policy will cover the risk of death for a term only, maybe 20 years, maybe 30 years. If something happens to the customer during the 20 or 30 years, the full sum assured will be paid to the family. But if nothing happens to the customer, he survives, he lives up to the date of maturity, nothing is payable to the family. Means this has got a death benefit but no maturity benefit. Such a policy will take care of the first need, family protection, but it will not take care of your retirement income. So, term assurance policy. But term assurance policy can always be the first policies to start with because it is very cheap. By paying about 5,000 rupees a year, you can get risk cover for about 25 to 30 years for about 10 lakhs or more. So, term assurance policy, it is only covering the risk of death and it is useful for family protection only and not retirement income. The second policy is return of premium plan, ROP plan, return of premium plan. This is also a term assurance policy with an extra condition that if the policy holder survives to the date of maturity, the premiums paid will be refunded. That is why it is called ROP plan, return of premiums plan. So, this is devised because some people feel if you take a life insurance policy and pay 1 lakh in 20 years and don't die, all the 1 lakh is forfeited. They feel it is a loss. It is not a loss. Protection will always mean some payment. If you want a security guard or a bodyguard, you have to pay. So, if you want protection, you have to pay for it. It is the cost of protection premium. But some people don't understand these things. They feel in a term assurance policy, what all premiums you have paid are gone. To take care of such people's objections, they have introduced this ROP, return of premiums plan. In case the policy holder survives to the end of the policy or to that maturity date, all the premiums are paid back to the customer with interest in some life insurance companies. Otherwise, the premiums are refunded. This is the ROP plan. Then there is a peculiar policy, pure endowment policy, not endowment policy. Please don't mix up this with the endowment policy. I am talking about the pure endowment policy. Pure endowment policy, they pay only if you survive till the end of the policy. If you die during the term, no payment is made. This is surprising. We think that life insurance they pay on death, no? Yes, but this is an exception. In a pure endowment policy, no death benefit is there. They pay you only if you survive till the date of maturity. Only maturity benefit is there. This is not sought after by many people. This is for a person who has no family, a loner. Because he has no family, he doesn't want any family protection. But because he is a loner, his children will not take care of him in his old age. So he wants to take care of himself. So this policy is taking care of retirement income but not family protection. Then the endowment insurance plan. A few years ago, 80% of the policies sold by LIC were endowment policies. Obviously, endowment policy is very popular with the customers. Why? It is taking care of both the twin perils of family protection and retirement income. If something happens to me, my family will get the amount. If nothing happens to me, I will get the amount and I shall use it for my retirement income. So, because it is serving two needs in one policy, this was very popular some time back. So, actually the endowment insurance plan is nothing but a combination of the term assurance and pure endowment. Term assurance is taking care of death benefit only and pure endowment is taking care of maturity benefit only. If you combine both these, the endowment assurance policy is taking care of death benefit also, maturity benefit also. Then whole life plan. Whole life policy, they also pay only on death. But unlike the term assurance policy, it has a term, some 20 years or 30 years. If you die during the 30 years only, they are going to make a payment. If you survive to the date of maturity, no payment is there. But whole life policy, it is covering you all your life. It is covering the customer all his life. So there is a definite payment. So this is costlier than the term assurance policy because under every whole life plan, the customer is going to die someday, sooner or later. And when he dies, we pay the family. Here, unfortunately, the customer will not be receiving his amount. Now, of course, there is a relaxation of the rules. If he completes 80 years of age, they are making the payment to him. But formerly, whole life policy proceeds will not be received by the policy holder at all. Then joint life insurance plans. Normally, insurance policies are taken on the life of one person. Generally, policies cover risk on one life only. But the joint life policy covers risk on two lives. The two people may be a married couple or they may be partners in business. these two people are covered by one plan. This is the joint life insurance policy. Here both the lives will have to be underwritten. Both people will have to undergo the medical examination, and the underwriter will see how insurable they are. Can they be given policies, or they are not up to the mark health wise. All these things are taken care of by the underwriter, and then the joint life policy is given. Now what are the benefits? It depends. Some joint life policies, they make a payment on the first to death. For example, husband and wife have taken a joint life policy. If the husband dies, they pay the wife. If the wife dies, they pay the husband, and that is the end of the contract. But recently they are introducing joint life policies which are offering more. Of course, they will also cost more. Some of the joint life policies, if the spouse, if the wife dies, they pay the husband. But that is not the end of the contract. They continue to bear risk on the life of the husband, and on his death a second payment is made, or on his survival to the date of maturity a second payment is made. Suppose both the people survive to the date of maturity, only one maturity payment is made. This is about the comparatively recent joint life policies. They are covering risks on both the lives. They are also providing for a maturity value and all that. All these are nothing but variations of the endowment assurance policy. Then money back plans. Endowment assurance policy, they make the payment either on the death of the policy holder or on his survival to the date of maturity. Whole of the sum assured is paid either on death or on maturity. Some people prefer policies which will be making some payments at intervals, because some financial needs will be arising from time to time, and we want some fund to tide over such problems. So money back policy has been devised. Money back policy, in case the customer takes the policy and pays for some 5 years, say, it can be once in 5 years or once in 4 years. So after he pays premiums for 5 years, a survival benefit is paid. It is a percentage of the sum assured. Some percentage of the sum assured is paid after 5 years. And again after 10 years, another percentage, another installment which is called survival benefit is paid to the policy holder. And the last benefit and all the bonuses will be paid on the date of maturity. So instead of paying 1 lakh in one installment, they are paying 1 lakh in 4 or 5 installments. That's all about the money back policy. But here is a very interesting point which most people miss. A person took a money back policy for 1 lakh. He received 20,000 first, 20,000 next, 20,000 next, 60,000 he already received, and he died. Full sum assured of 1 lakh is paid to the family. The installments already paid are not deducted. But if he survives to the date of maturity, only the balance is paid. 60,000 has already been paid so far. So on the date of maturity, only 40,000 and the bonuses are paid to the customer. But in case he dies, full sum assured is paid to the family, even though some installments have already been made earlier. They are not deducted from the claim amount. Child plans. Child plans don't serve a purpose actually. They are generally given to inculcate in the child the saving habit or some such thing. Children's policies, they differ from the regular conventional policies. In a regular conventional policy, risk starts immediately the contract has come into being. When an offer is made, the proposal is given, the customer is making an offer to enter into a contract. And when the company accepts the proposal, it is accepting his offer and a contract comes into being. The first premium receipt is issued and risk starts. The policy document will come afterwards, but the moment the first premium receipt is issued, risk will start. That is in the case of a conventional life insurance policy. But in children's policies, you may take a policy for a 3-month-old baby, but risk will not start immediately. It will start at some age like 7 years or 8 years. And that is known as the deferred date. So after he reaches 7 years of age or 8 years of age, risk will start on the policy. If he dies before that, the premiums paid are refunded. The premiums paid are refunded, but no sum assured is paid. But after the deferred date, in case he dies, full sum assured is paid. So much about the children's plans, but there is one other point. The father has taken the policy on behalf of the child, because the child, a minor, cannot enter into a contract. The guardian, the natural guardian father, has signed the proposal and entered into the contract. Okay. Does it belong to the father or the child? The policy. because now many fathers and children are having quarrels regarding property. So this policy, does it belong to the child or to the father? When the policy was taken, it belongs to the father only. That is the property of the father. But when the child reaches age 18, some companies say 21, when the child becomes a major at age 18, automatically the title will pass to the child. So the child becomes the owner of the policy. That is called on the vesting date. The vesting date is the policy anniversary when he has already completed 18 years of age. He becomes the owner of the policy and the father has no other connection with the policy. So after becoming the owner of the policy, the child will have to make a nomination. In case something happens to me, in case I die, payment may be made to so and so, my father, my mother, my wife, like that. So that is about a children's policy. But these are mainly given to inculcate in children the saving habit. One advantage of these policies is, now people are getting health problems at very young ages. So when your child is 25 years, he has got a job, he wants a life insurance policy, he may not be insurable. The insurance company may say, he is not a standard life, he is a substandard life, we cannot give him a policy. If you take a policy when he is a child, this problem is avoided. Automatically he is getting a policy, insurability is guaranteed. That is the advantage of a children's policy. Then unit linked insurance plans, ULIPs as we call them. ULIPs or unit linked insurance plans are nothing but insurance and investment. Insurance and investment, premium paid by the customer. Supposing he has paid some 10,000 every year. A very small part of it takes care of the risk cover aspect. Some 1 lakh risk or some risk cover will be there. And the balance is invested in shares, in the share market. In some securities it is invested. Here one point is very important. In the ordinary policies also, our premiums are invested by the companies, but they don't seek our suggestion, they don't seek our option. They invest them as they like, and they also take the risk of investing. In the ULIPs, they ask you where shall we invest the amounts, in high risk policies or low risk policies, high risk securities, medium risk securities or low risk securities. So according to your instructions, they will be investing, and if something goes wrong, you have to bear the loss because you selected, you wanted them to invest in high risk securities. So that is the problem with these policies. You are not sure about the amount you are going to get on the date of maturity. It may be very high or it may be very low. Now in case the customer lives up to the date of maturity, they pay either the fund value, means the market value of the securities which were purchased in your name. The fund value is paid to the policy holder. In case he dies, suppose he pays only 10,000 rupees and dies, then they will pay the fund value or the sum assured, whichever is higher. That option is there to see that people will not get a feeling that they have lost everything. So this is about a unit linked insurance plan or ULIPs. ULIPs are very popular now. This will be good as long as the share market is okay. If something goes wrong there, we will be disappointed. Then micro insurance plans. Micro insurance was recently introduced some 6-7 years back. IRDA wanted micro insurance plans to be introduced. What are these micro insurance policies? Now in any company, if you want an endowment policy, if you want any conventional plan, the minimum sum assured is 50,000. If you want a policy for 10,000, they will not give. 50,000 is the minimum. Actually 50,000 should be the minimum because it is a very small amount. But it may be a small amount for you, but for people living below the poverty line, it is a fortune they cannot even reach. They cannot pay premium for a 50,000 policy. But they also require insurance. And the government and IRDA wanted to bring life insurance within the reach of all people, even those who are living below the poverty line. So for their sake, they wanted the companies to necessarily issue these micro insurance policies. Micro insurance policies, sum assured will be between 5,000 and 50,000. Above 50,000 you want, you can take a regular policy. But for people who cannot afford to take a policy with a high sum assured, these micro insurance. So life insurance has been brought within the reach of all people, even people living below the poverty line. That is the greatness of these micro insurance policies. Lastly, annuities. Annuities are nothing but pension plans. It's not a life insurance plan. On the contrary, it is a reverse of life insurance. Why? In life insurance, The company takes the risk. If a person takes a term assurance policy, pays 5,000 rupees and dies, 10 lakhs is paid to the family. Company is taking the risk. In a pension plan, the pensioner or the annuitant is taking the risk. Supposing he has invested 5 lakhs, he has paid to the insurance company, I want a pension plan. Okay, they gave the plan. And one installment was paid. Then he died. That is the end of the story. He paid 5 lakhs or 10 lakhs, he got only 10,000 or 15,000 and all the rest is lost. So people were afraid of the annuities or the pension plans. So now they come with some guarantees. Even if the customer dies shortly after taking the annuity, there will be minimum guarantee for 10 years or 20 years. They will ask you, do you want a guaranteed life annuity? So we pay the pension at least for 10 years, at least for 20 years and thereafter as long as you live. So life annuity also is there and the minimum guarantee is also there. And it is for you to choose the options and which you prefer most or which you think will serve your purpose more. Then there are some other aspects of insurance. For example, you hear about an endowment policy with profits, endowment policy without profits. What are these profits? We have participating and non-participating policies. That means with the profit policies and without profit policies. If you want a policy, they will ask you, do you want an endowment with profits or without profits? You say with the profits, good. They will collect a little more amount along with the premium and that they will invest and the returns will be paid to you in the form of bonuses. So if you take a 1 lakh policy, along with bonuses, you may be getting 1,80,000 or even 2 lakhs. But suppose you say, I want only a without profits policy or a non-participating policy. Okay, the premium will be less. But if you take a 1 lakh policy and pay for 20 years, you will be getting only 1 lakh because you did not opt for profits. Then we have convertible insurance plans. What are these convertible insurance plans? You can take a term assurance policy and after say 5 years, you can convert it into an endowment policy. You will ask me, why should I take a term assurance policy and convert it after 5 years to endowment policy? I want to take an endowment policy right now, but then it may be costly. Term assurance is very cheap, endowment policy is not cheap. So you want insurance. Unfortunately, you are not able to pay the premium now, the full premium for an endowment policy. So you take a term assurance policy now with the proviso that after 5 years you are given the choice how you want it to be. You say, now my position is okay because 5 years means you must have got 5 increments and 5 rises and even some promotions. So I want to take an endowment policy. Another advantage in these policies is, supposing you want to take a policy 10 lakhs now for endowment and after 5 again for 10 lakhs. After 5 you may not be eligible to take a life insurance policy. Policies are not offered to every Tom, Dick and Harry. You should be insurable. Insurable means you must have an income and you must have good health and habits. So insurability may disappear overnight. So better take the policy now when you are eligible for insurance. So you take a policy with a lower premium now and after 5 years when your prospects are better, you convert it to a higher policy. Term assurance policy you may not like, they are not paying any maturity benefit. Okay, you take a term assurance policy which becomes endowment policy after 5 years. So now you are getting the risk cover for the full amount and at the end also you are getting the maturity benefit. That is the advantage of convertible insurance policies. Then we have group insurance. What is group insurance? The general policies we sell are known as individual assurances. You are selling policies to individuals and you are insuring individuals. It is possible to insure an entire group with one policy. That group must have come together with a common objective. People who have gathered together with a common objective. Employees of a company, or customers of a bank, or members of a professional body, or a trade union members. All these are having some other objective to come together. And we can insure all the people with one stroke, with one policy. Here, another advantage is, the premium will be generally lower because the employer sometimes bears the whole cost of the policy, sometimes he meets part of the cost. So it comes cheap. Number 2, no medical examination is necessary because we are entering the whole group. We don't need to be afraid. All the people who are on the rolls, or rather all the people who attended office on the day, will be automatically covered. No medical examination is there. People who are on sick leave on that day, after joining, they can undergo a medical examination, they can join the group. This is a valuable protection because many people take policies and lapse them during the currency of the policy because they cannot pay the premiums. Group insurance policies, the employer or the secretary of the association is taking care of it. You are in safe hands. Lastly, salary saving scheme known as SSS. Salary saving scheme is not a product. It is not a plan. It is only a mode of premium payment. As you are aware, premiums can be paid yearly or half yearly or quarterly or monthly. Now this is another mode, monthly direct or monthly salary saving scheme. If you pay monthly through salary saving scheme, the premium will be cheaper, number one. And it is deducted by the employer from your salary and remitted direct to the insurance company. You don't have the botheration of going to the insurance company and making a payment. Number two, once the money is paid to us, there are so many bills waiting for settlement, and life insurance policy may have the last priority. And if you don't pay the premium, the policy will lapse. So if the employer deducts the premiums and remits them direct to the insurance company, your policy it does not lapse. It is in force. And your protection also is there intact. If a policy lapses, the protection will go. So salary saving scheme policies are very useful and it's a very convenient way of making the premium payments. The next aspect we are examining is taxation. Tax exemption is one of the strong selling points of life insurance. Some people take life insurance policies only for tax purpose. That's not correct, but that's the fact. What is the tax exemption we are getting by taking a life insurance policy? That we shall examine. According to the Income Tax Act of 1961, exemption in tax is given at the investing stage also, that is at the premium payment stage also, at the claim stage also, when we are receiving the maturity claim or death claim stage also. So, what is the tax exemption we are getting at the investment stage? According to section 80C of the Income Tax Act 1961, life insurance premiums paid up to 1 lakh in a financial year qualify for deduction from taxable income. What does it mean? I paid 1 lakh premium during a financial year. Financial year, you know, is from 1st April to 31st March next year. If I pay 1 lakh insurance premium, I will be getting exemption of 1 lakh. It is by way of deduction from the taxable income. My income actually is 4 lakhs. My annual income is 4 lakhs. I paid 1 lakh insurance premium. So this 1 lakh is deducted from the 4 lakhs and I have to pay tax only for 3 lakhs. That is the exemption I am getting. So any premium I pay up to 1 lakh, if I pay 2 lakhs premium also, I will get exemption only for 1 lakh. If I pay premiums paid up to 1 lakh in a financial year are eligible for deduction from the taxable income. The premium is deducted from the income and only the balance amount is taxed. Life insurance premiums paid up to 1 lakh in a financial year qualify for deduction from taxable income. This is a very valuable exemption to the customers and many people they stress this point and affect sales. Now there is one condition. What the one condition is, the premium should not be more than 20% of the sum assured. You have taken a policy for 1 lakh. The premium is 20,000. That is, it is a 5-year policy. Normally, nobody takes a 5-year policy. You have taken a 1 lakh sum assured endowment policy. You are paying 20,000 rupees premium. You will get the exemption. But if you take a 1 lakh policy and you are paying 25,000 premium, it is only a 4-year policy. You will not be getting any exemption. So, this is the condition. The sum assured, the premium should not be more than 20% of the sum assured. 20% is okay, but more than 20% of sum assured, if the premium comes to, this facility is not allowed. This exemption is not allowed. Second thing, claim stage. At the claim stage, what are the exemptions we are getting? Claim stage, section 10(10)(d) of the Income Tax Act 1961. Maturity benefit or death benefit received from a life insurance company is tax free. I got a sum assured of 3 lakhs from the insurance company. Maturity proceeds of my policy. I need not pay 1 rupee tax on that. all the maturity claim payments, all the death claim payments, they are free from tax deduction. They are tax free. This is a very valuable concession for the customers, and you should take advantage from this facility. But here also that condition applies. Premium should not be more than 20% of the sum assured. Then inflation. What is inflation? Prices are going up. We are all feeling the effects of inflation. Inflation is the rise in the price of goods and services in the economy. The price of gas is going up, the price of electricity is going up, the price of services. If you go to a hospital also, they are charging you more. So we are in inflationary times. So what is the effect of inflation on life insurance? I took a policy for 50 lakhs. I thought 50 lakhs is an ample, I have made ample provision for my family. If something happens to me, they will get 50 lakhs. They can clear all loans. They can lead a decent life. But after 5 years, I find that 50 lakhs is not a big amount. That is not sufficient to take care of my family protection. So, insurance requirements should be reviewed periodically, and new policies should be taken if necessary. So, every 4 or 5 years, I should see what are the policies I am having. I am having a 50 lakh policy for family protection, and also to take care of my assets and liabilities, the loans and all that. That is not sufficient. So, I may like to take another 10 lakh policy. So, you should periodically review your insurance portfolio and see if it is adequate to take care of the inflation. Needs are so many. We have seen that there are so many needs for a householder. There are so many needs for an individual with a family. So, he has to take care of all of them. But all people are not having fat salaries. Many people have a very meager salary. They cannot take care of all these things. They cannot take a policy for family protection and for children's education, children's marriages, health insurance, all these things they cannot take. So what is to be done? That is prioritizing. We have to give priority to certain matters, and first you have to attend to them. Subsequently, you can attend to the rest. Now, prioritizing protection needs to be prioritized as of the needs we have seen already. Some are critical. Critical need means top priority. Urgently you have to go in for that. Family protection, top priority. Then high priority needs, medium priority, low priority. So you classify your needs like this. What are my critical needs? What are my high priority needs? Medium priority needs and low priority needs. And the resources you have. Your income will increase after a few years. Right now, you are not in a position to take care of all the needs of the family. So, resources to be allocated accordingly. How to prioritize needs? Some more points. Protection of future income. Protection of future income should be number 1 item in your needs list. Protection of self and family from medical health problems. Of course, you will be taking a health insurance policy for that. So, these are top priority things. Then planning for children's education, planning for children's marriages, they come next. They are important, but not so important as to take care of the income of your family. You can't allow your family to become destitute. So, that is top priority. Then children's education, children's marriages, then protection against home loan and car, then planning for retirement. All these things can be taken care of. So, it all depends upon your income. If you can take care of all the needs, well and good, go ahead. If you cannot take care of all the needs, you prioritize them. Which is my critical need? Which is my top priority need? Like that you have to arrange these things and allocate the resources accordingly. So, prudent approach towards protection needs. One has to be prudent. He has to be very guarded, very cautious in dealing with these things, because these are life and death questions. Your responsibility to family is the most important responsibility. Prioritize them and immediately start with protection for critical and high priority needs. As we have seen, critical needs and high priority needs ought to be taken care of immediately, whatever be the income. Start with smaller investments for medium priority needs and increase investments later. For the marriage of your daughter, you take a small policy, you take a policy for 5 lakhs. 5 lakhs will not be sufficient. But to make a beginning, you take a 5 lakh policy. After some time, you can take another policy. So, you can invest it. You can begin in a small way. Postpone the low priority needs. Retirement income is important, but that is a long way off. So, you postpone them And when you are in a position to take care of it, you do take care of it. Postpone the low priority needs for some time and take them up later when additional financial resources are available. Here are some questions and answers we shall examine. Hari wants a constant life cover till his 31st birthday, but he can't afford to pay high premiums. The best suited products for him would be pure endowment, anticipated endowment, term plan, ULIP. Term plan is the cheapest thing. Anybody should be in a position to afford the term insurance policy. Though there is no return, it covers an important need, it gives you protection. So, term plan is the answer. C is the right option. Ram has invested 5,000 in PPF, Public Provident Fund, and rupees 1 lakh in life insurance premium, in which he will get maximum tax benefit. PPF is getting only 5,000 rupees and is investing 1 lakh in life insurance premium. So, life insurance premium is the first option, PPF next, 50% on each, 95% on life insurance premium and 5% on PPF. So, life insurance premium maximum exemption he is getting. Without submitting any form of claim, generally if you want a claim check, you have to submit the discharge. Here is a case where he did not submit any discharge. Still he got a payment, he got a check. Without submitting any form of claim, a life insurance policy holder received payment of survival benefit. What type of policy is he holding? 1. ULIP, B. Term, C. Money back, D. Health. It is a money back policy. In an endowment policy, sum assured is paid at the end of the policy on the date of maturity. In a money back policy, survival benefits or payments are made at every 5 years or every 4 years like that. So, for that the requirements also are not many. If it is a death claim case, we have to take care of a number of forms. So, without submitting any form, he got the check. It is a survival benefit payment under a money back policy. After maturity in a unit linked life insurance policy, customer does not get received maturity in a lump sum. What is the possibility of receiving it in installments if it is not an annuity plan? It is not a pension plan, but it is a ULIP. Supposing it is a policy for 10 lakhs. We expect to receive a check for 10 lakhs or slightly more or slightly less. But this man got a small installment and next month also he got another installments. Why is this happening? It is not a pension plan. Now, some people want to receive their maturity proceeds in installments because of a need they have, probably children's education or some other thing. So, in such cases, there are settlement options. He has opted for settlement option is right, B. Settlement options is, we can give well in advance before the policy matures. I don't want to receive the maturity benefit in one lump sum. Kindly arrange to pay me in yearly installments of 50,000 each, 1 lakh each, etc., etc. So, because he has opted for settlement options, the settlement is made not in a lump sum, but in installments. For assessing the risk of a group seeking a health insurance policy, which of the following information is most critical? Health insurance also, we are having group insurance policies. You can give a health insurance policy to an individual, you can also give it to a group. Now you are trying to insure a group, maybe the employees of a company or the customers of a bank, etc., etc. Now, what do you take care of? Which factor is most important? Is it group lifestyle? Is it employees? Is it age of the group? Medical history of group? The right answer is C, age of the group. Because when age increases, the health also, there will be more and more health problems and the company will have to pay so many claims. So, your first consideration will be, what is the age of the group? That is the most important consideration. The agent can use the benefit illustration document to show the client the projected growth of investment at the rate of. Benefit illustration document is, instead of orally talking to the customer regarding the benefits of a policy, now people are preparing some documents and passing on to them. So, if you pay so much in these years, you will be getting like this. So, so much money will become so much and all that. There, you are not supposed to paint too bright a picture about the future because you want to affect the sale. You may like to tell him, you will be getting so much of money and all these things, which may be true, which may not be true. So, that is why IRDA has some controls even in this regard. 6% and 10%. the agent can use the benefit illustration document to show the client the projected growth of investment at the rate of 6% and 10%. This is quite fair. So, these are the questions and answers. Thank you.